Boom. I think we're now recording. Perfect. So I really want this to be a conversation because this is really a conversation that should be happening more, right? Like this is conversations that should be happening not just over Zoom at 8 p.m. on a Thursday evening in the middle of our hectic lives, but all the time in our friend circles, in our work circles, because we are all trying to grow. And the more we all grow individually, the more the community can thrive as a whole. All right. So one of the ways we can thrive individually and really even the playing field in terms of building wealth amongst ordinary people. And I say ordinary people because we are all extraordinary in our own way. But when it comes to finances, there are just people who are separated from the rest. And we know this, right? But to even the playing field a little bit, the stock market offers a low barrier of entry for someone to get into and reap the rewards of a high-end investor. So today we're going to really dive under the hood of Apple. The ticker is AAPL. If you don't know that already, then you've probably been living under a rock, but Apple is probably one of the biggest companies in the world. The brand is recognized everywhere. Excuse me. And what we're going to talk about today is not necessarily what Apple has done, but where it needs to go or where it's trying to go in order for it to still remain on top in terms of being a great, dominant company, which it is. All right. So let's kind of like dive into Apple a little bit and understand the tailwinds and the headwinds that are coming its way. And with that, let's dive into Apple. Okay, let's do it. So, got to put this disclaimer up. All right, I'm going to read this just so you know nothing gets confused here. I am not a financial advisor or fiduciary. This content is intended to be used and must be used for information and educational purposes only. You should make decisions based off your own analysis while considering your own personal circumstances and risk tolerance. As you can see here, you can look for all of those things, but not from me, all right? They're not pointing directly at me for a reason, okay? Do your own research. All of this stuff becomes a lot more fun and a lot more rewarding if you research and find a learning point that is comfortable for you, all right? What I'm doing here is just trying to disseminate information that I've learned that have helped me become more in tune with my investment in Apple. I am long in Apple, full disclosure, so take that for what it is as we go through this presentation. All right, a little bit about me real quick, because this is important to understand where I'm coming from. I started investing in the stock market right after college, like many of you guys, probably in a 401k. And I was very passive in that. Didn't know much about my own kind of investment strategy or where my money was going when it was being taken out of my paycheck. The one thing I was most worried about were taxes. You know, when looking back, I should have been more forward thinking and not worrying too much about taxes in the way I was thinking about, wow, they're being taken out, but more so how I can preserve the capital that I was earning so that later on in my life, I wouldn't be having to work as hard for that capital. So I started in 2013. A couple years after that, I got my master's in criminology and public policy. I'm not a background in finance. I do not have a degree in banking or anything regarding the financial sector. I just have a high capacity for learning these things because I understand how important they are to building generational wealth, especially in communities that are traditionally underserved and underrepresented. All right, so that passion for serving the community has led me on my journey as an entrepreneur and business owner, which has really lit the flame to being very passionate about investing because the system is designed to help entrepreneurs and business owners, but they don't teach you that. They teach you that you more so are better off being a cog in the machine instead of trying to be a machine that is contributing to world value, right? So that's where I'm coming from. I'm not some guru. I'm just trying to pass along information that I think is valuable to know to help you invest according to, your own wisdom. So with that, let's talk about Apple. All right. The thing about Apple is that it's really a chameleon. It's something that you really have to kind of really peel back the layers of and really look at it from a different lens, because the different ways you can look at it, like a chameleon, the colors are changing, right? So if you want to look at it one way, you'll see it one color, right? But if you're looking at it from a different lens, you'll see it a different color, right? So Apple itself is not old. 41 years old, okay? It was IPO'd in 1980, which, if you think about it, in terms of how big and huge it is now, only 40 years to go from a company that was about to go out of business to the world leader in multiple categories, in multiple sectors, multiple industries, okay? It's classified as a hardware, technology, storage, a lot of things that like you wouldn't really think about Apple in terms of their expertise, but that's how they're classified within the industry and the sector to really kind of give you an idea of where they fall. But I feel like that is something that is misleading, and we'll get into that a little bit later. All right. Coinciding with that is what they do. All right. On the surface, they make smartphones, tablets, Macs, things that make our lives a lot easier, right? Things that are in our face all the time, things that we must use and that we must integrate into our lives in order for our lives to be a little bit easier, right? So on the surface, that's what they do, right? And that's what led them to have a market cap of over $2 trillion. Apple is by far the biggest company in the world by market cap. I have here the market cap definition. That is just another way for you to really identify which companies are worth your time and which companies are really moving the market, right? A company with a large market cap like Apple is going to be less influenced by the movements in the market, right? So their stock price isn't going to fluctuate too much because they're so large, right? A company with a small market cap with not too many shares being out there floated around, being bought and sold, one big buy order, one big buy order, one big sell order is going to move that stock price up and down, right? So when you're thinking about market cap, that's the important part. It's not necessarily the formula or anything. We're just comparing companies to size by size and allowing ourselves to get a general sense of how companies move within their sector and industry, but also in regards to the larger market. Another cool thing about Apple is that its 52-week price range is pretty variant, right? Which is telling of both its growth over the last year, but also of what you can really expect in the future from them to continue doing, right? These numbers might look a little weird to you if you're familiar with Apple and what it's been doing the last year or so. It did split back in August. I'll get into the splits a little bit later. But as you can see, from a low of 64.75 to a high point of 145. So again, investing a little bit of money at its low back in March, see what that money could have done for you in just a little bit of time, right? Comparing that to the S&P, the largest index that we have that moves the market, it beats it by 44%. So right off the bat, you're looking at Apple and you're like, wow, this company not only dominates by brand, but it also dominates when it comes to financially, making other people money, right? So let's kind of bring it back to Apple and its IPO price. It started at $22 a share, right? December 12, 1980. Imagine you had invested $1,000 into Apple at that IPO price and never sold. Think about that. First of all, think about the patience you need to have to, reap the benefits of that. But also think about investing as a strategy, the length of time it might take to either gain or lose a certain amount of money, right? So just keep that in mind, that $1,000 price point, and think about how much it would be now from $22 a share to where it is now at $130 per share. All right. So just keep that in mind. As we talk about the competitors a little bit, these competitors in the grand scheme of thing, again, really contribute to the chameleon aspect of Apple, right? The industry and the sector say the competitors are Dell, HP, and Hewlett Packard Enterprise. Dinosaurs, okay? Like, is Apple really in competition with HP, which purely makes computers? Is Apple really in competition with Hewlett Packard, with Dell, purely desktop computer plays? That's what Wall Street says. That's what they classify Apple is. But as we'll dive into a little bit more, that is just a misdirection, right? Apple is competing with other people, not in their sector. There's other people in the sector that they compete with, but not as well, right? So moving on from there, this leads into the $1 million question, right? If you had invested $1,000 in Apple and never sold, you would have $1.2 million. $1.2 million that you didn't have to work for, that you didn't have to punch in, that you didn't have to sit in front of any clients, any patients. You didn't have to exchange your time for any type of money. You just let one of the biggest, baddest, most dominant companies in the world work for you. $1,000. How often do we just spend $1,000 on things that we don't need? And before you say, oh, I don't spend $1,000 at a time, you don't need to, right? A little $5, $10, $20 here and there adds up over the month. Sooner or later, you've bought your way out of $1.2 million. Something to think about. So let's talk about some key dates in Apple's history, right? We can go over all their metrics in terms of when they first hit $1 billion quarter, when they first hit their $50 billion quarter, $100 billion quarter, all that kind of stuff. But that's not really important. What I really want to highlight when it comes to splits is one, that the company has to get to a certain level of size and confidence within themselves to keep delivering value to want to split their company for two reasons, right? From a psychological reason, even though it's not true in terms of value dilution, psychologically, when you hear of a split, you automatically think the share is the value is being taken away, right? So when you're splitting your company, you have to deal with that psychological effect of people not understanding the split is actually the company still staying at value, but allowing more access of that stock for people, right? So when a company splits, they're actually doing the public and their shareholders a favor, right? The company doesn't obviously have to split, but they're doing that to give more access to the average retail investor to get into their stock, right? So there's a big, hoopla about Amazon and their split, who knows? But it depends on really, does Amazon really want more retail investors within their stock? But back to Apple, right? Founded in 1976, remember it IPO'd 4 years later, right? So when we're talking about IPOs, that's pretty quick, right? That's a company knowing who it is, knowing what value it can bring to the public, and then making the decision to get underwritten and go through that process of raising the capital needed to go public, right? And they did it in 4 years. How many times did Airbnb's IPO date get pushed back? Airbnb was supposed to IPO like 2 years ago. Roblox is another recent one. Companies, they don't go according to plan. So early on, Apple, even though their stock wasn't successful, they were able to show that they were about this business. They were not playing any games when it comes to trying to build something that was long lasting and forever, right? And that plays a role. Split number one came 7 years after the IPO, 2-for-1 basis. They were being kind of cheap. That's frankly how I see it, my perspective. 13 years later, split again, 2-for-1, right? At this point, in 2000, you have the dot-com bubble. Apple, the internet technology itself was in a place where it was on the highest pedestal it's ever been till now, right? Apple was still only splitting for 2-for-1. So that told you that the company still was not ready to let retail investors hold significant amounts of the stock. They still wanted institutions to hold the shares because they were confident that the institutions would continue buying their stock and keeping it on that pedestal. But what happened in 2000? Dot-com bubble, crash. Most companies didn't have the equity or the cash available to kind of save themselves. So after 2000, and kind of that little bit of recovery, Apple decided, hey, we can't wait another 7 years. We can't afford to keep waiting to allow more and more people who have access to internet, people who now have our phones, right? People who are now going to have more access to Apple. We have to give them more access to Apple stock and reap the benefits of that. Split number 4, notice the date here, 2014, came after Tim Cook got there. And that is important for a couple of reasons. Steve Jobs, as great as he was as a founder, was very stingy and set in his ways. He didn't want retail investors in Apple stock, let's just call it what it was. He didn't really want shaky hands. He didn't want people who were fearful of the ups and downs of the tech industry holding on to the stock. After Steve Jobs, rest in peace, passed away, Tim Cook comes in, and as an innovator, not a founder, not someone who is about the P's and Q's, the numbers, that kind of, he's someone who's a thinker, creative, comes in and says, we need to give more access to our shareholders. That's what would make the most sense. We need more people in our stock, more people talking about our stock, more people who are in our stock who are able to now pass stocks on to their loved ones and their families. And Apple now becomes a generational wealth builder, right? Obviously, I wasn't in those shareholder meetings, but a 7-for-1 split can only tell you one thing. They were ready to give away some Apple stock, right? So June 9th, they agreed to that, 2014, right? Fast forward 6 years, again, they make another astounding run from 2014 to 2020. They split again, 4-for-1. What does this all mean? It means to tell you that Apple has been around, it is still around, and you can probably bet that it might be around later on. And they've set a precedent. So if you're waiting for Apple to split again, you probably don't have to wait long. Okay. So any idea on how long or how much Apple stock would be if it split? If it hadn't split, the price would be. Let's see. Oh, yeah. Any idea, y'all? Any guesses? It's okay. You don't have to participate. So this is really important to think about because it really. Oh, what we got? Oh, it's in the chat. I love it. 8K. That's a good guess. Any other guesses? And if you know the answer, I mean, you can throw it up there. Nice. I love it. 2K. Nice. So we got to think bigger, y'all. We got to think bigger. 10 more seconds. Any other answers? All right. So if Apple never split, it would be about $28,000. So when we talk about investing, right, we're talking about something about building generational wealth in making sure people are financially secure so they don't have to work forever, right? How many people right now can afford $28,000 into one asset? Not many, considering 76% of Americans are living paycheck to paycheck right now. The thought of putting $28,000 into one share of a company sounds very scary, right? So what Apple is essentially doing is making themselves more accessible because the more people have it, the more they can give back and the more people can be deeper into their ecosystem. But good guesses, y'all, good guesses. Moving on, let's talk a little bit about their leadership. All right, I really just want to touch upon a couple things on their leadership. Tim Cook, great innovator, came in 2011, but people forget that he was at IBM before Apple. So he had the stuff before Apple really knew what they were, right? So they had the iPhone 2005. They had about 6 years of was there feedback on it? Oh, okay. If you think about it, there was only 6 years between the iPhone and when Tim Cook got there. So there wasn't a lot of time and a lot of versions, a lot of innovation that had happened between then. But once he got there, iPhone, Mac, all that kind of stuff really started to take off, right? Because he had wherewithal. The CEO, Jeff Williams, COO. Key thing here, he's the lead innovator on the Apple Watch. So when Tim Cook gets all the woo about Apple's innovation, really think about Jeff Williams, who is not muted. Oh, sorry, y'all. Cool. All right, we're back. So when we're talking about Apple a little bit, Jeff Williams, innovator on the Apple Watch, give him a little bit of credit. Luca Maestri, key thing here, he was starting at General Motors, and he had 20 years of finances in Americas, Asia Pacific, and Europe. Two things here. General Motors, what is one of the revenue streams that Apple is really trying to dive into right now? Anybody want to guess?
Self-driving cars.
Self-driving cars. Yes, cars. Where can Apple go next? Cars. It has to be something more innovative than what they've already done. So why not bringing someone who has the not only the expertise with one of the oldest, most dominant players in the automobile industry, but also someone who has experience working in areas of the world in which Apple has yet to really penetrate. All right. As someone who has lived in China, I can tell you that the dominant phone player is still Samsung, right? Apple still lags behind Samsung when it comes to phone sales per year, right? When it comes to phone sales per year, Apple is still behind in that, right? So why not bring in someone who can help you penetrate that Asia Pacific market, which is projected to really grow 30, 40, 50% in the next 5, 10, 15 years, right? Why not put your money where your mouth is there? And then last but not least, Kate Adams, really want to highlight her, not only because she is a woman in leadership, but also because she worked at Honeywell, which is one of the oldest, biggest, baddest companies in the industrial industry. And what are their main things? If you don't know, it's okay. If you have no idea, it's really okay. They really deal mostly with aerospace, right? You know, where is tech? Where is the industry? Where is innovation going? We're already ruining this earth, right? We can only survive here for so long. Where's our next stop? Can't be here. All right. So when you're thinking about leadership in your investment strategy, think about not only about the CEO who's running the ship, but who's around him, who's really steering the ship in the direction that it needs to go in. And does that really align with the leadership strategy and the mission of the company, right? Moving on. So talking about leadership, right? One of the things that we really have to talk about more so in investing is impact investing. How well are you making your money, but are you doing more harm than good while you're making your money, right? Dirty money is not good money, right? All money is not good money. So it's okay to make money in certain ways, but you got to really ask yourself ethically, are you making the right decisions? And are the companies that I'm putting my money behind, can I trust them to make good decisions to not only keep profits coming in, but not sacrificing human lives or the work of others or the environment or anything that is going to do harm? We're not sacrificing that for profits. Like we never do that. We never want to do that intentionally. So when it comes to ESG, Apple, we have to admit, is very, 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 very poor. And in comparison to how big and how much money and how much influence they have, they do very little in terms of keeping their ESG intact and up to date with where the industry is going, but also just not doing a great job of hiding it. Like they're not very contrite or like sorry when it comes to the things that they do. Um, they do have some initiatives in place that is trying to mitigate a lot of that, but for the most part, it's a lot easier for them to pay for things to keep staying how they are than to improve, and that's the case for a lot of companies. Um, One of the things that I really want to point out here is that governance is probably for me the most important part here. These other two things, environmental and social, are things that can be fixed if the governance is there, if the leadership is there and the leadership wants to be impactful and change. A lot of these management teams are very concerned about their stock compensation, their compensation, the share price, and not necessarily concerned about how their company is rising. So we got to be really conscious of that. So these average, laggard, and hold on, yeah, average, and laggard. This is coming from MSCI Research LLC. If you want to look into them a little bit more, they do all research on ESG on the companies, and this is how they kind of rate Apple in those types of categories. And here's a little bit of chart. Here's a chart that shows Apple in comparison to its competitors. So again, these are industry competitors, which means these are only people who compete with Apple within the technology, hardware, storage, and peripherals industry. All right. So in comparison to Dell, HPQ, and HPE, Apple is actually lagging behind them pretty significantly. All right. But who in here really wants to invest their money in any of these other three companies in comparison to Apple, right? If and again, I'm not a financial advisor or fiduciary. I'm not telling you where to put your money, but the future of investing is investing in the future, right? And these companies, I'm not really sure, even though their ESG is great, but maybe that's because they're not really taking any chances. Who knows? All right. So let's move on a little bit from there. So let's get a financial snapshot of Apple, and there are a bunch of different metrics you can use to really identify the financial health of a company. But here are 6 of the ones that I really look for when I'm evaluating a company and whether or not I want to invest in them now, later, or whatever. Okay, so pay attention to the total revenue, and this revenue is trailing 12 months. So this is all the revenue they've made in the last 12 months. I'll tell you right now, Apple just had their biggest quarter ever. They made over $100 billion in this last quarter alone, which is unreal amount of money if you think about it, considering they've made 294 billion over the last 12 months. So they already made over stupid money in just a quarter. So they'll probably hit, and a lot of that is iPhone sales, Christmas sales, and stuff like that. But they'll probably hit well over 350 billion this year, well over. Their net income, so their profit, right? Apple is probably one of the most profitable companies out here. And when I say out here, I mean in any industry, any sector. They had $57 billion in net income in 2020. But one thing to point out is that when it comes to profit, that can change over the year depending on your margins. Okay. So their net revenue, and their net income have seen like mixed results over these last 2 years. So that, keep that in mind when I go over the bear and bull case in a little bit. All right. Their earnings per share. So this measures the profitability of how much profit they make. So you can have a company that's profitable, but they can be barely profitable, right? You're not getting much as a shareholder. You're not getting much partake in that profit from your money, right? We want companies that are profitable, but also that are the more money we put into them, the more we're getting back from them, right? So that earnings per share that they reported, 1.68 per share, is important because that directly ties into their PE ratio, right? So that's their price to earnings. What is their current price, right? And how much are you paying to partake in their profit, right? So how expensive is it for you to hold on to Apple stock right now, right? Their PE ratio is 35.7 compared to the industry average of 31.3. That's slightly above average. So think about this. Yes, Apple is expensive for its industry, but look at who's in its industry. Like it's chess and checkers, right? Their PE ratio, considering, even though it's higher than the industry average, and that can be considered by most as overvalued compared to their industry, you could also argue that Apple's probably undervalued compared to the other people in their industry, right? You can argue that you're paying less to get shares of Apple than you are to get shares of Dell, depending on if you really think Apple is just a hardware and peripherals storage company, right? So depending on how much you want to pay for the shares, right? Look at the PE ratio and compare it to other in the industry. Another important thing for me is debt to equity, right? Look at companies, how you want to control your own finances, right? Do you want to invest in a company that has a lot of debt? Maybe you're that type of person who understands that company's debt cycle and understands why they're in debt, right? Good rule of thumb, 2.0 in terms of the debt to equity ratio, meaning a company that borrows more than 2 times than what it, it borrows more than 2 times than the equity that it owns within its shareholders, that's not optimal, right? You don't want a company borrowing 3 times, 4 times, 5 times more than what they own, right? That shows poor governance, poor money management, and you wouldn't want yourself over leveraged in life. So why would you want to invest in a company that is also over leveraged? But when it comes to Apple, we don't have to worry about that because they have $88 billion in cash flow. So that means any debt that they do have, they could pay it off tomorrow and feel good about themselves, right? So think about that also. Like not all bad debt, not all debt is bad debt, right? Especially when it comes to a cash cow like Apple, who also pays a dividend with that money that is left over, right? So all that extra money just sitting in banks in reserves right now, Apple is actually paying their shareholders a dividend that they started doing in 2012. It's not a lot because they do spend still a lot of their money on research and development and on product development. So they're not paying in comparison to a lot of other tech companies, their dividend is nothing, but they're paying you to hold the stock. So take it for what you want. So bull versus bear case, right? Buying, selling. The key thing to remember here is the buyers want the market to keep going up or the stock to keep going up. The sellers want it to keep going down and they profit off of that. Both sides make money here. The one person who is not making money, who is actually losing money, losing their life savings, losing their retirement, losing their grocery check, losing their paycheck that 76% of Americans are looking forward to every single week or every 2 weeks. Those are the people who are getting slaughtered. And more often than not, I'm not saying everybody, but more often than not, people are losing money because what? Couple guesses. Do we have any guesses? Simple answer. They usually, we got, oh, I love it. I love when we have communication here. I gotta show the chat. Oh, there's the chat. To the moon. Greed. That's one. That's one. Greed is one. That's a dangerous one. But more often than not, it's because people don't have a plan. People don't have a strategy. Investing is not gambling, right? You should not equate investing and gambling. Gambling takes a lot of luck. But with investing, you can mitigate your risk and you can make money as long as you have a plan, right? Don't be a pig. Don't get slaughtered, okay? I care about y'all. So let's talk about the bull case for Apple. Again, I preface this saying this, I was long in Apple. So I am invested in Apple in the long term. But that does not mean I don't think that there are some potential headwinds for Apple coming forward, that they can be in serious trouble if they don't address these, at least in a way that is satisfactory for their shareholders, if we're talking purely from a Wall Street perspective. Okay, so from a bull perspective, right? Here are 3 reasons. I had to narrow down to 3 for why you should, or not should, or why you should consider buying Apple and or holding. If you're already in it and you're thinking about, damn, should I sell it? I'm telling you right now, it's been on a little run this week. It's up $10 this week. Yeah, if you've been following it, right? Buying, selling, holding, whatever you want to do, here's why you should be buying or holding. Reason number 1, they have a supreme moat, right? So when you think about a moat, you're thinking about an advantage that is impenetrable, right? Apple doesn't have just one moat, not just 2, 3. They have 4 identifiable moats, right? They probably have others, but there are 4 concrete reasons why their competitors can't touch them. And that is very, very, very important when you talk about building a brand and a business, when the majority of businesses fail in their first year, right? A lot of businesses don't make it to year 5. And don't forget, Apple IPO'd after 4, right? So Apple has already set the precedent for why they should, and why they have been great and why they can continue to be great. And they've developed 4 distinct advantages, being their switching moat, their network effect, pricing power, and their brand loyalty. So switching, how many people in here have an iPhone? All of us, yes, right? How many of us also have a Mac or an Apple Watch or some other device in which Apple has our information duplicated on, right? How frustrating and how, time consuming would it be for you to switch to a Samsung phone or a Google phone, right? All your information, all your cloud is now on a phone or somewhere where you cannot easily transfer, right? Apple just makes things easier so people don't want to switch, right? You guys all raising up your hand saying that you guys have iPhones is also their network effect, right? I'm sure a lot of you didn't just wake up one day being like, yeah, I'm trying to get that iPhone. At some point down the line, someone either showed you theirs, you heard about theirs, you saw someone else in there in your family taking a cool picture, and you're like, damn, like that color came out crispy. And, at the end of the day, you're like, I want one of those. So that's the network effect, right? Pricing power, iPhones are very expensive, but you'll pay for them because of the other 2 modes, right? Pricing power is everything. When you control the product, you control the price. And in terms of the last one, brand loyalty, I don't know about you guys, but I curse Apple every day, but I know for a fact I probably will never leave them, right? They would have to do something very catastrophic and or do something that completely throws me off my thesis of them, or changes my thesis of them, right? So those are their competitive advantages. We talked about their elite balance sheet. They have too much cash on hand, personally, in my opinion. They need to do more with it, either by giving more of a dividend, buying back more shares, or buying more companies. You can't just let $88 billion sit, all right? We know inflation is going up. We know cash, the value of our fiat US dollar is not going up, it's going down. Apple needs to do more as an investor. Even though they have an elite balance sheet, they need to do more as an investor to make sure that money is working for them. And then they need to have, and then they have a commitment to innovation, right? They spend a lot of money on R&D. R&D is research and development. There's only so much you can research before you really have to start developing, right? So this innovation piece is a bull case, but it leads into the bear case, because again, innovation is the future. If you're not investing in innovation, you're lagging behind significantly, right? So for two potential growth drivers that we're waiting for, and is really going to teeter Apple into legendary status or another big business that couldn't get over the hump of continuous innovation, right? That AR, those AR goggles, augmented reality, kind of mixing virtual reality and real reality, and then that Apple car, whether or not they create their own, whether or not they buy a Ford or they buy a GM, buy a company that already has automobile production, or they just create the software that integrates into the cars of a Volkswagen, of a Toyota, something like that, something that already has an EV presence. So we don't know what they're going to do, but whatever they do, it's going to move the share. It's going to move the stock, right? Bear case. On the flip side of innovation, they are significantly lagging when it comes to things that are going to be helpful for continuing to be dominant in the future, right? AI, space exploration, machine learning. To be frank with you guys, Siri sucks. Siri is a terrible attempt at machine learning and AI, and Apple just can't get it right. I feel like it responds more to you sitting on it than you actually talking to it, and it's lagging behind the Amazon Echo. I think Google has its own type of Ask whatever, so it really needs to catch up to other companies, even companies like Tesla that focus on machine learning. They're lagging behind in the AI department. Going in terms with the ESG, in terms of impact investing, Apple needs to do better at not only stopping kind of all the lawsuits that have been coming their way in terms of discrimination, both both like racially and sexually in the workplace. We all know about their kind of seedy production line issues, their danger to kind of clean tech, their environmental waste. We don't know what they're doing with all these damaged iPhones. They could be telling you they're refurbishing them, but that's a lot of phones. And our landfills are way too large and way too full for Apple to be, to be as secretive as they are with like their waste habits. So if you're an impact investor, be aware of Apple. And then lastly, in terms of this bear case, the privacy concerns. The world is moving to a place where privacy and data are currency. The more private you can be, the less access people have to you, the more power you have. On the flip side of that, the more data you have and the more information you have on people, the more power you have. So you're going to start coming into that tug of war of who has the information and who can do what with it. You're already seeing that with the Facebooks and the Apples and the Googles being called in the antitrust hearings in front of Congress. People want to know, what are these big companies doing with our data? What are they actually doing to keep themselves in that mode of making money hand over fist without having to answer to anybody? All right. So what are my recommendations? Again, I'm not a financial advisor. I'm not a fiduciary. I am not someone who is going to tell you which stock to purchase. I'm not someone who's going to tell you what asset class to invest your money in, but I am someone who's going to tell you that education is first and foremost, right? Taking action without having the information or at least the awareness behind the thinking behind that investment choice, you're going to really do yourself a disservice. And it's going to really teach you some expensive lessons, right? You don't want to lose money. The goal is to keep money, right? You can never go broke taking profits, right? But you can go broke making mistakes over and over and over and over again and not learning from them, okay? Understand your risk tolerance. This is paramount. This is the most important thing you can learn as a retail investor, as someone who doesn't have a crap ton of money to be just throwing willy-nilly. You have to understand your risk to reward ratio. How much can you afford to lose to gain a certain amount of reward, right? Your risk to reward ratio has to be something that you think about. Your profit loss has to be something you think about. How much are you willing to lose, right? Nobody can care more about your money than you do, right? No one should care more about your money than you do. So if you're going to go seek out financial advice from anybody else, just make sure you are also doing your own research, right? Pick a strategy and stick to it. This goes with having a strategy. Have a plan first. Pick a plan, and once you have the plan, once you've researched, done your homework, stick with it. Don't go chasing other plans, other strategies that you haven't researched, other stocks, because you feel as though, damn, that stock is running. You know, so and so said this stock is going to blow up in 2 weeks, right? FOMO is not a strategy. I'm sorry. You know, like you can't get rich by playing the oh I'm missing out game. Something I didn't write here also is hope. Hope is not a strategy. You can't hope that a stock is going to go up. You can't hope that a company is going to get better, right? Do your research, do your due diligence, and ask for help. There's plenty of resources available to help you pick your strategy and help you stick to it. And then lastly, start today. All right. When you're investing, you're buying back time, right? The old adage is the best time to start investing was 10 years ago. The second best time is today, right? Is right now. So don't worry about what you haven't done, what you missed out on, any stocks that, damn, I had it when it was 33 and it's 2000 now. Who cares? You know, there will be other opportunities, and you can't seek and capitalize on those opportunities if you're not playing, right? Sitting on the sidelines makes you no money. It keeps you average and keeps you working until you die. And that is not the goal of life, all right? The goal is to spend more time with your family, your loved ones, and doing things that you want to do. And investing helps you do that by buying back your time, all right? So those are my recommendations. They have nothing to do with Apple, right? But they can give you a sense of how you should approach investing in a company like Apple, but also how you're investing your money in your day-to-day, right? Lastly, here are my services. You can reach out to me for pretty much anything. But here are the things that I'm truly passionate about when it comes to finances and in managing money and helping money grow and helping communities grow and helping wealth build, and helping more of that money. I hate using this phrase, but trickle down. Like, we're all still waiting for the money to trickle down, right? It's now time for us as regular retail investors to now go get it. Like, let's trickle up and let's start going to get the money that we have access to, right? So anything on financial literacy, I can help you get started on, get you educated on, whether it's credit, retirement, crypto, debt reduction, anything. I can guide you and support you in that learning process, because education is scary when you're not sure where to look, right? But none of these things, all of these financial vehicles, are things that should not be scary. These are things that you should be able to use every day to get better, right? Platform selection, there are a crap ton of platforms, but there are certain ones that are better for certain investment strategies. So if you need help with that, I can help you explore the right one for you. And then when it comes to investment strategies, there are no right or wrong. All right. I don't want to say there are right or wrong. There are ones that are better than others, right? But as long as you have researched and done your due diligence, any strategy is worthwhile, right? So don't get stuck on any one strategy. Just be cognizant of the fact that there are other ones that could be helpful for you. All right. And lastly, I want to just open up to questions. I know that went, a bit long, but hey, Apple's a big company. There is a lot to really uncover when it comes to Apple, but I want to give you guys a perspective on it that wasn't just, fun facts. There's a lot of things that Apple does within their own brand that is going to be very telling of where we go as a society. So with that being said, thank you guys. And if you have any questions, let's do it. Let's see. My chat's not popping up. Let's see. All right. Question from Carla. Do you think Apple would be wise to invest in transportation, i.e. high-speed rail? Yes, yes, absolutely. The interesting piece with Apple is that I think right now they have options. They can really approach, especially something like infrastructure. Yeah, exactly. We definitely need a train to Springfield, like ASAP. But in terms of transportation, I think the country itself needs an infrastructure overhaul. We are so behind when it comes to other smaller, more developed countries when it comes to linking other people, linking people together. So when you think about where the world is going, we need more communication, right? And we need more access, right? You can only talk behind the screen for so long. You can only text and blah 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 before people want to get out their house and go see each other. Um, I think the country would do well in investing in infrastructure as a whole. And the way you do that is not using government money, it's getting companies like Apple, Amazon, the Caterpillars, the Honeywells, that already do these things, that already connect people, both online, but also through roads and building things, and get them to work together to pool their own money that they have in these cash reserves to make these railroads, to make transportation, to make these underground things, to make these things that are pipe dreams now without real money, to make those reality. So I think Apple would be very wise to do so. And if they're thinking purely from where to go next, because I think that's their biggest question, that's a good place to go, is investing in infrastructure. Definitely. Alexa over Siri for sure. Um, any other questions?
I'll just throw it out. Just curious, maybe like when you were first starting out, like, are there any like big mistakes that like you learned from like right away, like whether it's like a company just like buying into the hype, or like, not, or even buying in on a big company, but just like when it was overvalued, like any like sort of like lessons that you learned in like areas like that?
I guess the biggest thing when it comes to when you're first starting out is obviously the education piece and all that good stuff, doing your research. But if you're going to pull the trigger on buying an actual stock, my biggest thing would be understand that stocks don't always go up, right? So leave, I was like, the phrase is, keep some powder dry, right? So if you have like a good idea of what the stock's going to do, but you're not very sure on its timeline of doing that, I would say leave some powder on the side, invest a small portion, you know, in like a little bit at a time, a couple shares, and then watch it, right? If it goes down, you still have capital on the side to dollar cost average and buy some more, right? In terms of the hype, it's like there's hype every day. Like the information overload is serious. Like you can really drown yourself in trying to chase every single stock. But the biggest thing is just identifying your area of competence, right? If you don't understand how the business makes money, don't buy the stock. If you can't tell me how the business makes money in 3 sentences or less, you probably are going to sell that company when they have one bad earnings report, right? You're going to have weak hands. So the more research you can do, the stronger your hands are going to be when a company takes that 10-15% correction, and instead of being like, whoa, this isn't the direction I wanted, and selling, you're like, oh, this is on sale. Your perspective starts to change, when you start to look at the companies a little bit more of a, um, as as whole bodies, right? Like it's very important that you study them and date them and really make sure that you know them before you invest in them. So it's the biggest stuff. Oh, here we go. Oh, this is a great question. So I was actually doing some research on this the other day for my own. I was actually asking this question myself. So how high do you think the price might go again before splitting? Um, so the simple question, the simple answer is I don't know. I don't know. But there are some clues that you can look at in their past, and I'm going to go to their key dates again. Um, if you want to do some research on your own, some homework, you can go and look at the price Apple was at when they split, right? One thing to consider is that when the stock splits, that doesn't mean that was when the decision to split was made, right? So that's one thing to consider. So if a stock split at 385, the company might have made the decision to split that stock at 300. And by the time, or we're gonna split the stock once it crosses 300, right? And by the time it got to its next shareholder meeting and they were able to vote on that split, the stock was now at 385, right? But then they announced the split, and then after that you have a huge run up. So Apple may run up to like it did this last time in August. It may run up to like a 600 stock price before it split, but the decision to split it might have came at like 300. So when it comes to Apple, you can get a pretty good sense of when it's going to split again because it has a history of splitting. So for some start to think as a shareholder, my company, the government, the management team might be thinking about splitting at around 250, 300. That is probably the next barrier where now they are going to split because Apple is very concerned about the retail investor. If you look at how many people own, if you go and look at the statistics of Apple, it's only about like 52% institutional ownership. That's crazy. That's crazy. That means pretty much half the company is owned by us, the average person, the average retail investor. So Apple has a duty to us to make it more accessible. So right now it's at 130. Don't look for Apple to split for probably another 3, 4, 5, 6 years. But they get this car going, anything can happen. Any other questions? We are at that 1 hour mark. Don't want to hold on to y'all too much longer. Yep. Yep. So that's another thing to really consider when you're investing in a company is institutional versus retail ownership. The Another way to kind of make investing simple is follow the money. Where are the whales putting their money, right? That's not to say that institutions aren't owning Apple, but Apple is just so accessible now. It's so cheap now. There are other better growth prospects in other industries that institutions who have obligations to their clients to meet a certain percentage each year, they have to move away from Apple because it's not going to move as much because so many retail investors are in it. So it's one of those things that if you're looking at a company, you're looking at a company that has like an 80, 90% ownership, institutional ownership, that's a company you want to really look at because that's high confidence from these mutual funds that have more money, education, access than we do, right? So follow the money and you'll see where the big fish are putting their money. The car, right now, there is a lot of secretiveness around. I don't know if that's a word, but there's a lot of secretiveness around the car. But the general sense is that there's going to be two ways they can go. They can either three ways. They can create their own production, right? Build their own car manufacturing company, which would not be ideal. That would cost a boatload of money. Two, they can buy a already established conglomerate who is nationally known, already has production in place, aka General Motors, Volkswagen, a Volvo, a Toyota, and just buy them, which would be a boss move. That would be such a power move. They just bought one of those, man. Again, but that would suck because that would cost them a boatload of money, right? But the cheapest way that I see in terms of getting market share in vehicles while still keeping who they are as a company, as a brand, because think about it, Apple Cars, is that really on brand? Is transportation really on brand in terms of the actual vehicle? Thinking about it, it would make more sense for them to invest in the car infrastructure. So the Apple Car having thinking like a Ford truck, but like all Apple interior, right? Like your phone connects, touchscreen, Siri, blah 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 blah. But Ford manufactures it, right? Because Apple doesn't have the capacity to do both right now. So that's two ways. I'm not sure when the car is supposed to be out, but those are two ways you can really think about where they can go when it comes to automobiles. For a new trader, which technicals do you look at, or new traders be learning? So I'm going to preface this question with my preferred strategy is long-term investing, right? So I'm looking 5-10 years out. I do implement some trading strategies, but that is not something I advise a newer investor to really dabble into until you've understood the fundamentals of looking at a company and investing in a company and looking at a company for at least a year, looking at its movements, getting comfortable with these price changes, that kind of thing. But I will say, when it comes to technicals, my favorite technicals are the Bollinger Bands, all right, the RSI, so that's the relative strength index, and or the MACD. So that is the momentum indicator. So that those are three different indicators that I use on my charts, where this kind of leads into this point here about sticking to a strategy. I can tell you right now, there are dozens upon dozens upon dozens of indicators you can put on your charts. But don't have a chart orgy, please, right? Like 1, 2, 3 indicators will tell you what you need. One indicator will give you what you need. Learn one indicator and master it. You don't need a bunch of different technicals to tell you that Apple's a great company, right? I use fundamental analysis, technical analysis. You know, those things are perfect hand in hand. But try to learn one first, fundamentals first, and then move on to your technicals. Yeah, so RSI and MACD, so MACD. So that's the momentum indicator that tells you, depending on your time frame. This is real technical, y'all. So if I'm losing it, it's okay. This tells you on a specific time frame what the momentum on the stock is, right? Are more buyers into it and shifting the momentum up, or does it have more selling pressure, right? I like to look at the MACD on a yearly chart, because again, I'm a long-term investor, right? A yearly chart, if a MACD is positive, that that tells you a lot different story than a positive MACD on a 3-month chart, right? It doesn't tell you as much of a full story. So, and I'll just explain the relative strength index real quick. So that tells you the buying and selling pressure of a stock. So it tells you whether it's oversold or overbought, right? So generally something, a number over 70 is overbought territory, and a number under 30 is oversold. I generally try to look for things in that oversold territory. I'm looking for deals. I'm looking for things that are being sold by these shaky hands, these people who are fearful of the market. So those 3 indicators together tell me where the share price is, where the stock can go, where it's been, where its support, where its resistance is. But from a fundamental standpoint, I also know, like, hey, the stock price is what you pay, right? That doesn't tell me the value of the actual company. And that comes from understanding the fundamentals first. Anything else? Last before I go, guys, this was, again, a free presentation that I want to just give you guys an idea of how I look at companies, but also give you an idea of how we should be looking at investing in general. The stock market isn't the only medium in which you should be putting your money to work. All right. Inflation is real. The dollar is not backed by anything but the federal government saying that this is worth something. All right. I don't know about you, but that is not enough safety for me. Okay. So if you guys are really serious about, living to your potential, don't trade your time for money. All right. Don't trade your time for a piece of paper that is worthless. Right. Work hard, do what you have to do, but put your hard-earned money to work for you so that you don't have to do it forever and you can pursue other things. If this was valuable to you, let me know. I really want to do other ones. I'm probably going to do Tesla next. If you guys are interested in that, Tesla and Apple were neck and neck. And then I'll probably hit PayPal. I'll probably do a presentation on PayPal itself with some comparisons to Square within that, because those two are very together when you're talking about fintech. But there's my Venmo, there's my Cash App. This is all free. I love this stuff, but this is again me trying to present information and trying to get better at it. So if you guys found some value, let me know, and let me know if you guys have other companies. Cool. Awesome. Glad you guys liked it. Also, this will be recorded. I think it is being recorded. So if you guys want the replay, let me know. I will send it out to you. Cool? Peace, y'all. Go Apple.
Thanks, Antonio.
Of course. Later, y'all. Night.
Thank you, Antonio. This was very helpful.
Of course. Thank you for
And leave my Celtics alone.
Got it. Bye, guys.